There's a big debate spanning decades as to what is a better investment strategy. Is it active investing or passive investing? Let's talk about that. My name is Spencer Ford, CEO and wealth advisor with Conservative Financial Solutions and a certified financial planner professional. And let's get into today's video. All right, active versus passive investing. We'll start with active investing. Active investing is what you might expect. It's a more hands-on approach to investing. Someone is actively managing the portfolio with the goal of beating whatever underlying benchmark is set as the target by taking advantage of different market conditions and price fluctuations. Maybe your benchmark or the yardstick that you're using to judge the performance of the portfolio is the S&P 500, or maybe your benchmark is 60% the Russell 3000 and 40% the US Aggregate Bond Index. The benchmark you choose should be in line with the goals you're trying to accomplish. For example, if you're an aggressive investor with an all-equity portfolio of large-cap US stocks, then the S&P 500 could be an appropriate benchmark. But if you're one of a more moderate investor with a portfolio made up of a mix of small, mid-cap, large-cap stocks, and you also have some fixed income in there, a benchmark that includes the Russell 3000 and the US Aggregate Bond Index could be a better fit. What you are trying to accomplish and what benchmark you are using compared to your portfolio is an important part of whether or not active or passive investing is the right strategy. Some advantages of active investing are, number one, having more flexibility in volatile markets. Active investors can take opportunities to get more defensive when the market is in decline to prevent further losses. Number two is expanded trading options. Active investors might employ different hedging strategies such as buying or selling options to either pick up additional returns or protect against losses. Number three is tax management. Active investors may execute various trades to offset gains with losses for tax purposes. Some disadvantages are higher fees. If someone's actively managing the portfolio, that may cost a little bit more than what a passive investment strategy is going to cost. Number two is increased risk. Some active investing strategies, such as buying on margin or shorting a stock, can increase the risk of loss in a portfolio. And number three is trend exposure. If not disciplined, active investors can succumb to herd mentality or following the crowd. Now, let's talk about passive investing. Passive investing takes on a more buy and hold mentality of investing and resists the temptation to react or anticipate the stock market's next move. Typically, with a passive investment strategy, an investor is going to buy an index or a series of index funds to simply follow an underlying index. One of the most popular indexes is the S&P 500, but here's what you need to know. The S&P 500 is made up of roughly 500 large cap, mostly domestic, US company stocks. So if you're going to be in a passive strategy, I'd recommend picking a few different indexes to track or broaden out your investment reach rather than just only tracking the S&P 500. Some advantages of passive investing are, number one, low fees. Passive investing strategies are often lower in cost compared to active investing strategies because you aren't paying a portfolio manager to actively manage the investment. Number two is transparency. Passive investing is straightforward. You own the index. The underlying investment doesn't change unless the index changes, so you should know exactly what you have at any point in time. Number three is higher average returns. Historically, passive investing has proven to be more effective at providing returns similar to the index that it's tracking compared to active investing. Some disadvantages of passive investing include limited exposure. Passive investing often includes investing in an index, just like we talked about. If the investor isn't careful, this can mean missing out on opportunities that aren't part of a broad-based index. Number two is limited adaptation. As a buy and hold strategy, passive investing can lead to not having an exit strategy when a bear market rears its ugly head. I'm not advocating for you to try and time the market. It should just be known that a passive strategy is oftentimes a buy and hold strategy like we discussed before. Number three is limited strategy. Passive investors may also miss out on using other market strategies like options to help provide growth and mitigate loss. So what's better? Well, as with most financial discussions, it depends. Most of the time, it isn't just black or white, this is better than that. In my opinion, passive investing in indexes is a great strategy for young investors. The buy and hold strategy has proven worthwhile. It's proven to be a worthwhile strategy in the long term when it comes to tracking the market. It keeps costs low while you're trying to build your wealth. While active investing has more value as you approach retirement and you start taking income from your investments, because mitigating loss in down markets is an extremely important thing to do when you're taking income from your portfolio. While passive investing does have a history of producing better returns compared to active investing when compared to an index like the S&P 500, active investing has actually proven to be a better strategy in down markets. So if I'm boiling it all down, in my opinion, passive investing could be better for younger investors who are simply trying to grow their wealth long term, or older investors who aren't looking to take income or immediate income in the future. I believe active investing can be a positive option in times of volatility and can be helpful as income is being actively taken from the portfolio. And there's no rule that you can't blend the two strategies. For example, you may want to have some passive strategies where you are just tracking an index while mixing in some active strategies to gain exposure to different investments and opportunities that can't be reached through passive investing. To me, there's no one-size-fits-all approach to investing, which is why it takes defining your goals first to get the appropriate strategy. Thank you for watching this video. If you found it helpful, please hit subscribe and click the bell icon to be notified when we release new content. It really helps our channel. I'm Spencer Ford, CEO and Wealth Advisor with Conservative Financial Solutions, and I'll see you in the next one.